Well, we're coming up for our 10th anniversary actually, so we've been around for a while, but it's really only been the last 5 years when we've focused on our income strategies that we've brought those to market to retail investors. But a good solid grounding of 10 years of performance. The investment team we've added over the time, but I mean a lot of them have worked with me not only just at Plato but in prior lives when I was at State Street, so there's quite a few ex-State Street people there. And quite a few of those members of the team have actually got not only equity ownership in the firm, which aligns them with the firm and longevity of the firm, but also quite a few invest into the funds that we offer. Yeah, well, the majority of our investment team actually have ownership in the company, so they're aligned with the long-term success of that company, and that obviously is focused on performance. A number of the employees are also investees into the actual retail fund, so again, they're clearly aligned with that, and obviously things like performance are a key objective for all employees. So the Australian fund has dual investment objectives: to beat the index, so we need to outperform the index, but also to deliver more income along the way. And we're specifically targeting around 3% higher income than the market, which if you include franking credits in from a pensioner's perspective, that means it's around a 9%, 8.5 to 9% income target. Well, I think in Australia what we find is that franking credits don't seem to be fully priced, and they're something that pensioners and superannuation investors value, so we're getting the most value out of those. But also we find that dividend paying stocks tend to actually outperform in the couple of months around their dividend period. So we're actually trying to capture income but also capture value add by some of these market inefficiencies relating to dividends. We want to buy, obviously, dividend-paying stocks, but clearly we want to buy stocks that are good value, that are high quality, and that have good business momentum. I mean, there's no point in buying underperforming stocks. So you want to have high-performing stocks that pay dividends, and particularly we also want to avoid what we'd call the dividend traps, stocks that might trade on a high yield, but actually may in the future disappoint by cutting their dividends completely. Yeah, I think it's one of the key traps or important features of an income strategy is really to avoid buying what we call dividend traps, which are essentially stocks that may cut or completely cut out or omit their dividends. I mean, there's no point in having an income strategy, buying a stock and then it announces zero dividend at all. Share price probably falls 10, 20, 30% on the announcement. You're left with no dividends and indeed underperforming stocks. So unfortunately, some of the highest historic yielding stocks in the marketplace are likely to be dividend traps, and so it's key is avoiding those stocks. Yeah, I mean, obviously we can't avoid not buying banks, but actually we tend to run our portfolio and we aren't actually overweight banks because we actually buy and actively trade our portfolio to gather income rather than being always overweight high yielding stocks, which would naturally tend to be banks in Australia. So by trading our portfolio around dividends, to capture more dividends, we can actually run a sector neutral approach, not be overweight banks, but still generate extremely high levels of income. Yeah, I mean, this strategy is specifically targeted to retirees or pension phase investors or indeed charities who want to live off the income from their investments. And it's also managed from a zero tax perspective, which pension investors and charities are in that bucket as well. So we're maximising the value of franking for those investors, but in particular we're maximising their income objective because that's what they want. They want to live off the income from their investments. It's a fairly long-term investment. It's sort of 5 to 7 years because it is an equity investor. It's got the risk of equity markets, but indeed retirees have a long lifespan or should hope to have a long time span, so it should be in line with their longevity.